Hello, everyone. Good afternoon. It's Darnel Miller here, your host. It's 1:30, and we're scheduled to start at 1:30, but I'm just going to allow a couple more minutes for those that are just logging on now to join us. Hi there, for anyone logging on, we're just going to wait a couple more minutes so that we can let everyone who's logging on join the call. We should get started in about 1 minute. Hello, everyone, and welcome to today's webinar on reinvestment, rebuilding, and recovery. This is part of Inside ETF's Canadian webinar series, and my name is Darnel Miller. I'm Director of ETF Distribution for Manulife Investment Management Canada, and your host for today's call. Manulife is a proud sponsor within the Canadian ETF industry, with a suite of 11 multi-factor ETFs sub-advised by our partners at Dimensional Fund Advisors, known also as DFA. Before we begin, though, I wanted to cover a few housekeeping items. At the bottom of your audience console, there are multiple application widgets you can use. When submitting questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer the questions live during the webcast, but if a fuller answer is needed or we run out of time, we will do our best to follow up. You can expand your slide area by clicking the maximize icon at the top right of the slide or by dragging the bottom right corner. If you have any technical difficulties, please use the help widget. It has a question mark icon, and it covers the most common technical issues. An on-demand version of the webcast will be available by the end of this week, and it can be accessed using the same audience link that was sent to you earlier. Now on to our webcast. Manulife wanted to be a part of this webcast because we believe that financial advice makes a difference for investors. We strive to provide more than just investment results for clients. We believe in providing hands-on expertise that goes beyond, helping advisors help their clients build and protect their wealth for generations. This includes tax and retirement planning, thought leadership on behavioral economics, and of course, capital markets strategy. And for that reason, I'm pleased to be joined by one of Canada's most well-known investment strategists, Philip Peterson. Philip is Chief Investment Strategist and Head of Capital Markets Research at Manulife Investment Management. Some of you may know Philip as he is often asked to share his work on BNN and Bloomberg. He and his team analyze and interpret economic and market data on behalf of Manulife Investments clients and work with our portfolio management teams to provide guidance on strategies, asset allocations, as well as specific portfolio recommendations. The team's experience spans across all asset classes and geographic regions. Philip will be providing us with a global economic update, helping us understand where we are today and helping us make sense of what many would consider current unprecedented market dynamics. We'll cover many of the questions we're getting from advisors and investors, such as what we can expect this recovery to look like, how long it might take, how can the market go up while earnings are going down, are there parts of the market that may move faster than others, and of course, whatever questions you have for Philip. The session is really about you and your market questions, and I know there's a lot to cover, so I'll get out of the way and let us get started. Please remember today's webinar is interactive. Don't forget to submit your questions. Philip, it's a pleasure to have you, and thank you for joining us.
Darnell, thank you for having me, and thank you everyone for joining this afternoon or this morning if you're dialing in from the West Coast. It's my pleasure to speak to you today on behalf of Manulife Investment Management and give you our update in terms of how we view the environment, what we're thinking about through the recovery, and just give you some insights in terms of the current market, how it has responded, and how it's, I think, taken a lot of investors by surprise, some of the explanation around that, and what this means going forward, how we're going to perhaps interpret the market's activity and square that with the economic environment that we're in, and what that means for the gains that we see coming through the end of 2021. I frame it in the context of the truths. There are a number of truths that we see in the environment today that help to rationalize or provide some context to the markets and to the economy and where we're headed. And the first truth that we would identify is that this has not been your average bear market. In fact, we would include this is not your average recession, nor has this been your average recovery. On this first table or chart that we have in front of us, it highlights where we've seen the market from the top on February 19th to the bottom on March 23rd. We had a drop for this COVID market, if we can call it that right now, of 35%. Over on the left of that, we identify what we call baby bears or near bear markets, or in some cases, bear markets that occurred outside of a recession. Now, we use that as a point of context because this recessionary environment is very different from what we've seen in the past. Most recessions come about as a result of an excess in the marketplace, a bubble, whether it be an asset bubble or some type of economic bubble. For example, in 2008, what led to the great financial crisis was the housing bubble that was basically sponsored or supported by all the subprime debt that the banks were issuing. All the way back in 2000 and 2001, the recession of 2001 was really caused by the bubble that occurred in the technology space. And even if we went back to the Great Depression, the bubble that occurred there was basically a manufacturing or industrialization bubble, and as well as a massive excess in the financial system that led to the economic contraction and depression that followed. In this case, this recession has been very different in that it's been engineered by governments. It's been a sudden stop where we've been told you can't go to work, you can't go to restaurants, you can't go to movie theaters, just hunker down and we'll all get past this. And so that, I think, leads into why this has been a very atypical bear market and recovery. So we've been debating where exactly do we put this bear market in the context of the past. It's not quite a baby bear as we saw compared to, say, the fourth quarter correction in 2018. It's a little bit more substantial than that, but this recession also probably isn't going to be as long as what we historically associate recessions to be, which is 11 months on average going back to 1970. Now, if we look at then the prior bear markets in other recessions, we have the great financial crisis where we saw a drop of 57%. We have the dot-com bubble where we saw a drop of, you've got 49% there. You know, this one isn't even average for what we saw since 1970. And there's been a lot of questions as to whether we can see a retest of the market lows on March 23rd. We would say the further away we get from the March 23rd level, the less likely we could see a retest, although we're not completely ruling it out. If we use the examples of, say, 2008 and 2009, what happened there was the market hit what was thought of as the bottom in October of 2008, only to retest it and fall through it in March of 2009 before the true bottom, bear market bottom, was formed, and the resumption or the new bull market came as a result of that. If we compare it to, say, 2002 and 2003, in 2002, we saw a bottom in the market, and that actually was the true bottom of the market, only we did retest it a year later in 2003, got close to it, didn't quite get to the same level before the bull market really took hold. So in this case, we do think that there is a fair bit of risk out there that we could see a retest of the lows. Whether we break through it or not remains to be seen, but I think it might be a little too early to suggest that we are in the next bull market, especially given where valuations and earnings growth are likely to be. So when we put that in context, what we've seen is one of the sharpest bear markets, as you can see by this chart here, a very, very sharp drop over the span of really 4 weeks from February 19th to March 23rd again, followed by fairly sharp recovery. Now then we have to ask ourselves, what is the economic landscape that we're in that supports the recovery or perhaps calls it into question. Now, one of the things that we would say, or one of the reasons why the market, in our view, has performed as strongly as it has, is because one of the elements of uncertainty has been removed. And we say this time and time again, markets hate uncertainty. You tend to see greater volatility with the uncertainty in the environment, where there's very little that's uncertain in terms of the economic data that we're going to get over the next couple of months. We know, or we have been conditioned now and over the last number of weeks and months to expect the worst economic data that we've ever seen in our lifetimes. That be it unemployment data, as I'm showing here, be it economic contraction that we're going to see on a month-over-month basis, retail sales, pretty much pick a category, and the data is going to be the worst that we've ever seen. And so with that uncertainty removed, anything else is actually viewed as a positive. So in this regard, I'm going to put the context of what we saw in terms of the labor market last Friday to what we think is likely to continue through to the end of August. And so our estimates here, which is the green bar jutting out to the left, is the expectations for the total amount of job losses that we can expect as a result of the coronavirus lockdowns and the secondary effects of that. And I'll explain that in just a second. As we compare our estimates to what we've seen in the past, obviously, going back to the 1970 recession, or 73, 74, this is the worst job loss, or we're expecting this to be the worst for job losses that we've seen. We're estimating 36 million Americans will be unemployed or displaced from their place of work between March and August. Now, how do we square this with what we saw last Friday, where we saw some job gains? Well, we do think that we could see some revisions in this, and there are some nuances as well in terms of the household surveys and employment surveys that don't pick up necessarily on individuals that have been temporarily laid off by their workplace. For example, many Americans believe, I still have a job, I'm just not working today. And so that doesn't necessarily show up in the household survey. If you compare that to hours worked, you can see a fairly sharp drop in hours worked, which we think is perhaps more indicative of the true unemployment levels that we could see in the United States. And as such, we could see some revisions, some negative revisions to this labor market data for the June report. Now, on the positive side, when we look at the recovery, so we do think we're going to see 6 months of job losses. The first wave, if you will, was the obvious one. It was the government mandated shutdown. The second wave is going to be those companies that have held on trying to survive, but ultimately will fail and enter into bankruptcy. For example, we've seen that with Hertz, J.Crew, in Canada, Reitmans. We've seen it even in the United States, another one, Gold's Gym is another one. So these are some job losses that are occurring after the fact. And we believe there is going to be more of those through the summer months, as some companies have tried to hold on, but just won't be able to do so, and will have to go through some form of restructuring. Now, the recovery, though, if we look at the blue bar on this chart, when we look at recoveries, job market or labor market recoveries, we're actually saying this one, despite the great number of job losses, the recovery proportionately looks actually fairly quick. And we're suggesting an 18-month recovery of these job losses, which would take us into the first quarter of 2022. Reason being is a significant proportion of these jobs we do believe are temporarily lost and will come back online fairly quickly. And then as the economy continues on with its recovery into the first quarter of 2022, we think that we will return to a normal environment, and as such, recover those jobs, maybe not directly into the companies that individuals were laid off, but indirectly through other opportunities. And so this is, now we know this, and so this is why we think perhaps the market has responded actually quite favorably. Here's another thing, why we focus so much on jobs is it tells us a lot about what the earnings recovery might look like. So here I've got a colleague who likes to joke saying, all my charts are broken because my axes no longer work. We have to adjust them all. And that's true. And you can see the very, very sharp drop off in terms of the employment situation in the United States. Now, if you notice, you'll see earnings growth, or the year-over-year change in S&P 500 earnings, and it tends to follow the trend of the labor market. And so we do expect earnings growth this year to be a drop of somewhere between 20 and 30%. Again, this is what the market knows. In fact, I would argue that the market isn't even looking at earnings or concerned about earnings in 2020. The focus really is on the recovery in 2021. And that's really what we think the market is considering. And we have to really kind of square or put into perspective what we're expecting as far as earnings and earnings recovery in 2021 and what we're willing to pay for it. Currently, we would suggest the market is probably a little bit too optimistic, a little bit too enthusiastic in terms of the earnings recovery, as we think the earnings recovery will follow the labor market recovery and will take as well approximately 18 months to get back to 2019 levels of earnings. Another way that we look at it is through a heat map of manufacturing activity. Again, this gives us a good gauge in terms of the earnings environment that we're in and what it's going to look like going forward. So I'll quickly explain what this heat map is. Over on the far left, we see major economies around the world, and then we have a rolling 2-year snapshot of manufacturing activity. Over on the left is 2 years ago. Over on the far right is the most recent data set that we have as at the end of May. Now, green is a very simple chart to read. Green is good, red is bad. You can see 2 years ago, the global economy from a manufacturing perspective was quite strong. A lot of green on that screen. As we moved into 2019, started to soften a little bit, started to see more yellow and orange pop up. That was a result of the trade war that we saw between the United States and China, and that gave way to the coronavirus shutdowns, which are global in nature. And so it just tells us again where we are and why the market isn't surprised. We know the economic data is going to be terrible, so now we're looking for signs of that recovery. Now, the second truth, the third truth here is when we look at the money supply and we look at the market, we argue that what the Fed has done is support the markets, in combination, the equity markets, the bond markets, and the commodity markets. And it's a direct result of quantitative easing. And so here's how we look at that. The green line is the money supply, or M2. What M2 includes is your coins and cash in circulation, demand deposits, checking deposits, and so on. It normally grows at a steady pace that is in line with GDP growth. So as an economy grows, its money supply grows pretty much in lockstep with that. But you can see that the year-over-year change can be quite dramatic in some cases, and usually, or what we've seen in the last, say, 10 to 15 years, is that it's been with the Fed's involvement. Now, recently, we've seen a very sharp spike up in the money supply. It's near 25% year over year. This is a massive increase, and specifically, it's as a result of the Fed's quantitative easing program. And so, in this case, the Fed has been very effective in supporting the equity markets, the commodity markets, and the bond markets, as the increase to its balance sheet has impacted the money supply. And we should show here, this hasn't been the case in the past. For example, over on the far left of this chart, with the first wave of quantitative easing, or QE1, as it's referred to, we're calling it here the first wave, though. The green bar is the expansion of the Fed's balance sheet, that first tranche of quantitative easing. And you can see in comparison to the blue bar, or the increase in the money supply, that it really didn't have a material impact, right? And that's because as the Fed was buying the bonds, that capital sat on bank balance sheets. The banks didn't then lend it out, and you saw, in fact, the opposite reaction that they wanted with respect to the markets. The markets were actually down. Same thing with the second wave, or QE2. Fed expanded its balance sheet by a significant amount, little impact to the money supply, little impact to the market. Then we started to see QE3, or it was almost QE infinity at that point, and then the fourth wave of quantitative easing, where now the Fed's QE programs have had a meaningful impact to the money supply. It's almost been one for one, and that money has to find a home. And over these last two waves, it found its home into the equity markets. So what do we think going forward, though? Going forward, we think that there are limits to what the Fed can do. Typically, when you get the markets moving up like we've seen as a result of the Fed, I wouldn't call it manipulation, but the Fed's involvement in the money supply, you need earnings to show up. And that's when we put this together. We do think that earnings growth is going to be rather muted through this year, negative through this year rather. And in the first half of 2021, we will start to see that recovery, but we're only going to get back to where we were in 2019. We don't think we're going to see a resumption of growth over and above the 2019 levels till well into 2022. And so we do think that the markets might have stretched out, or rather pulled forward the gains that we should have received over the next year to year and a half in the last 50 some odd days. Now going forward, we do see positive markets, both on the equity side as well as the fixed income side. But the returns, I think we should be a little bit more tempered in our expectations. Now, the next truth is that the credit markets, in addition to what the Fed has done for the equity markets, the credit markets have remained well behaved. And to look at this, we use the Chicago Fed's credit conditions sub-index. So to read this chart, when the green line is below zero, credit is easy, right? Loans are accessible. If companies can come to the credit markets and raise money. When credit is tight, that's when the green line is above zero. Now, you typically see tight credit markets in a recessionary environment. In this case, that hasn't actually been so. So let me just go back 1 second here. What we see is that the Fed, in its bond buying program, through the special purpose vehicle set up by the Treasury, they have effectively put a put, if you will, on the credit markets, and that's why we've seen them perform actually quite well over the last couple of months. We've had high yield recover quite strongly, investment grade recover quite strongly, and we think that the Fed put is alive and well, not only for the equity markets, but also for the fixed income markets. When we look forward, though, there is a consequence to all this, and that consequence we think is going to be higher inflation. Our inflation model would suggest that we're going to see a disinflationary or deflationary environment over the next 6 months, but that is likely to give way to higher inflation in the first half of 2021 on a year-over-year basis before inflation settles in, but we do think it settles in above the last 10-year average, which has been sub 2%. We think reasonably we could see inflation at above 2 to say 2.5% through 2021 and into 2022. Now, this is likely to push the yield curve steeper. We can see a steeper yield curve by potentially another 100 basis points over the course of the next year, and which really, I think, puts long duration bonds and sovereign debt in a less favorable light, but really does focus our attention on credit. We think credit actually is quite attractive. Now, putting this all together for Canadian investors, one of the other things that we have to consider is where the Canadian dollar is going. And here's the fourth truth that we have here. The Canadian dollar is still tied to oil prices. We've had a number of calls with clients over the last number of weeks to months in terms of the direction for the Canadian dollar, and we're very happy to see it play out as we thought, which is regardless of the Canadian economy, regardless of the overall debt level of Canadians and what might be a slower recovery in Canada relative to the US or around the world, the Canadian dollar remains tied to oil prices, less so rates today, much more so to oil prices. And so that's what we want to reflect in this chart. The red line here is the Canadian dollar, the current value of the Canadian dollar, which sits right at around 74.5 cents today. The blue line is the fair value for the Canadian dollar based on oil, and the green line is the fair value for the Canadian dollar based on interest rates. Now, what we've seen over the last number of months is that there's been a breakdown in the correlation between the Canadian dollar and rates. Rates almost don't seem to matter anymore as they're being held lower by the Bank of Canada, lower by the Fed, all across the curve right now. And the Canadian dollar has reasserted itself as a petro currency. And so from here, with oil prices being around $36, $37 a barrel, but likely headed up over the course of the next 6 to 12 months, we see further upside appreciation for the Canadian dollar. Currently, it's trading almost exactly where it should be relative to oil prices at 74.5 cents, or if you think of the other way, about 133.5, 134 Canadian dollar to the US. Going forward, we think the Canadian dollar could be or could trade higher into a range of 75 to 77 cents. That's based on $40 to $45 oil. We think the risk could be to the upside from there. And then lastly, before we open it up to some questions, the fifth truth, and this actually ties to trying to recognize market bottoms and brings it back to, did we see the ultimate bottom on March 23rd? We're not 100% sure that we won't see a retest, but investor activity would suggest that that could have been the low. And so what I've been tracking over the last number of years is flows into equity funds, balanced funds, and ETFs, including ETFs in the United States, going back to 1998. And what you see, that those are represented by the green bars. And the blue line is the S&P 500 rolling 12-month return. What's really interesting is when you get the markets down on a year-over-year basis during sharp corrections or bear markets, the retail investor capitulates and you see panic selling. This is what we saw in December of 2018. We saw this in September and October of 2008, and then again a little bit in March of 2009, and we saw this in around 2002. And we saw it in March of this past year. That would suggest that, yes, maybe we did see the low and we can move higher. It doesn't justify the rally that we've seen in the market thus far, but it does highlight the capitulation that we've seen by the retail investor, which, as we've read over the last couple of weeks, has gone into the retail investors driving the markets higher. So I'll put this together. The recovery, the economic data, I think, is largely being discounted by the market right now because we know it's going to be bad. I mean, there is no, the data can't be bad enough to shock the market. Really what we think is the recovery is going to be a little bit more modest. If anything does spook the market, it is probably going to be a weaker earnings recovery than what is expected, or a shift by the Federal Reserve, given some of the perhaps better economic data that could come through. The Federal Reserve could start to ease on its support, and then we could have a version of the taper tantrum that we saw coming out of 2000, the 2008 and 2009 Fed support. Markets over the course of the next 12 months, we do think can continue to trend higher, but we're a little bit more modest in our expectations. We think through the end of 2021, our base case is that we could see mid to upper single digits for equity returns. We continue to favor U.S. equities, international equities, or put that together, global equities overall relative to Canadian equities, and we would also favor being hedged those positions. On the fixed income side, credit remains quite favorable to us relative to sovereign debt, and especially long duration sovereign debt, which we think is at risk given a steeper yield curve and higher yields over the course of the next 12 months. Darnel, I'd love to pause there and open up for questions.
Wonderful. Thanks, Philip. Always, great insights. We do have some questions from advisors on the line. The first question was from Alex. Just a point of clarification. You had mentioned the 18-month recovery. Alex just wants clarification on when the start date of that is. So is that expecting a second wave, from that point, or are you more referring to today in 18 months?
Good question. So when we think of the 18-month recovery, we're actually starting at the beginning of September. So we are not factoring in a second wave of the coronavirus at this point. We're not medical professionals in that regard, and we think it would be disingenuous for us to suggest that there would be. What we think, though, is what we're seeing right now. It's quite interesting. If you look at Florida, if you look at Texas, the case numbers are going up. In fact, the R-naught in Texas is at the highest level it's been, meaning number of new cases are increasing faster. But it doesn't look like Texas wants to shut down. It looks like at this point, economies in the United States would rather deal with the healthcare consequences than deal with the economic consequences of a shutdown. And so if we did see a second wave, I'm expanding a little bit more, Darnel, here, but I think it's important. If we did see a second wave, I'm not entirely convinced that economies would shut down in the same manner that they did, just recognizing the economic impact that it has and the damage that it could cause. And at that point, like, how far do you want to push on this string before the damage becomes irreparable? So we're excluding the potential for a second wave. Now, we could see, or what we think is that the economic recovery that we would say starts in September, in the fall. We do think, through the summer months, we'll have a plan in place to fully open up and deal with the healthcare consequences. But that recovery that we are saying will take likely 18 months will be perhaps not as quick. I hate attaching letter shapes to these things. I think it's fairly trivial to do that, but let's just say it's going to be a little bit more gradual. So sharp downturn, the angle, put it that way, the angle of recovery is going to be a lot flatter than what the descent was.
Great, Philip. And just along the lines of COVID, again, not into the medical side of it, but obviously the implications to the market. We've seen regional differences globally with how governments have responded to this global health crisis, and we've also seen timing differences just as a result of where the disease started first and where it started last. And so, are there implications do you think to the way that regional governments handled it, and obviously to the timing as well?
Yeah, and it's quite interesting because from an economic perspective, you sit there and you would think that, okay, China and Asia was first into this problem. I think they managed it very well, and they're opening up. Okay, great, that must be fantastic for them. Well, given the globally integrated supply chains that we have, it's something along the lines of, say, a rolling blackout, right? So, hey, this is good that the Chinese economy is ramping up. But guess what? Their customers are in the United States, or their customers are in Europe, and they're not putting in new orders. So it actually there's a second economic wave to the coronavirus that we've seen as a result of the disparities in time and the disparities in response. So along the same lines, if you look at what Sweden has done early on, they were being lauded or criticized, right? It depends on your viewpoint, for remaining fairly open. Their economy has remained fairly open, but their economy is still a function of exports, right? They export a fair bit to the rest of the European Union. And so despite remaining open, it hasn't really helped in terms of the number of cases. Their mortality rate is much higher than their neighbors in Norway or Finland. And their economy is still suffering because they're not insulated from what happens elsewhere around the world. So the economic drag is longer than just what we've seen in China alone because of the global supply chain. And therefore the recovery, that's where we think, unless we all are recovered all at the same time, there's going to be a lag and there's going to be that drag. And it's not going to be the sharp V that was predicted early on in this situation.
Thanks, Philip. And just a reminder to everyone on the line, we're seeing questions come in from the audience here. So if you have a question, please submit it. There's a Q&A tab at the bottom of the platform, and please submit it, and we will try to capture all questions here. Philip, we talked a little bit about the shutdown. Wondering if there's going to be long-term implications to the fiscal side of things. So governments have spent an unprecedented amount of money to try to help folks that are out of work and businesses that are out of business or could potentially go out of business. How big of an impact is the unprecedented government spending potentially going to have on governments and maybe their ability to help citizens and businesses going forward?
Well, let me say, over the short term, what I think governments have done in the United States and Canada around the world has been fantastic. I think if you're going to create this economic pause, the sudden stop, you have to provide some type of support. You can't just leave people on their own and say, yeah, you can't go to work, but you're on your own, good luck. So I think they've done a really good job with that. That's helped to, I think, ease some of the economic burden. But Darnel, as you point out, there is some long-term consequences to this. What are some of those consequences? Well, when we look at the United States, the U.S. is going to run a deficit this year that's going to be 20 to 25% of GDP. It's going to be a staggering number. So what we're likely to see out of that is a weaker U.S. dollar and higher long-term interest rates, which could also, I think a weaker U.S. dollar could lead to higher inflation as well. There will be tax implications down the road. I fully believe that the Trump tax cuts that were put in place in the last couple of years are going to be completely reversed. Just because the U.S. couldn't afford them in the first place, they're not going to be able to afford them now. So we're likely to see a combination of and it's all relative. So in this case, I think the U.S. deficit as a percentage of GDP is going to be far greater than the Canadian deficit to GDP. So the U.S. dollar is likely to weaken on its own relative to the yen, relative to the Swiss franc, relative to the euro. And I think we're going to see higher taxes, and I think we can potentially see some modestly higher inflation. I don't think it's going to be like 80s style inflation or late 70s style inflation, but higher than what we've seen over the last 10 years in order to pay for what we've had to contribute into the economy now.
Great, thanks, Phil. And switching gears to asset allocation, had a question from Henry here. Henry, thanks for the question. FANG stocks, obviously we've seen some parts of the U.S. market recover faster for obvious reasons, but wondering if you think that continues into the future. Is this going to continue to be a story of a small number of companies and business models that do well while others suffer, or should we start to see that expand as recovery comes back?
So, great question. What's really interesting is there is a misconception. It's probably media-driven in that we believe that the market gains have been really driven by the FANGs plus Microsoft. Because if you look at Apple, Apple is back to its prior high. I think it's actually higher than where it was in February of this past year. Microsoft has pretty much recovered. You have the FANGs that have done well, but when you look at the equal weighted index, the S&P 500 on an equal weighted basis is actually trending right in line with the market cap weighted. So it looks like the FANGs, given their disproportionate weight in the index, have really contributed a disproportionate amount of the gains. But there are many other companies out there, stocks out there that are up 50, 60, 70%. So it's not just the FANGs. And so we have actually seen some decent breadth in this market. We recently did a study, and we're going to be putting this out, on what we call the truths of bear markets, of bear market bottoms. And we've seen a lot of these truths come through in terms of cyclicals outperforming defensives. Value has started to not outperform, but caught up to growth. We've seen the home builders, that typically, are leaders in a recovery. They have led. The financials have started to participate. So the recovery's been fairly broad-based. But to your second point there, which is when we look forward, is it going to remain the case that all stocks will be up? Here, I would say no. I think, once, call it the smoke clears, and the rubble settles, you're going to have a real difference. You're going to have those companies that will benefit from whatever the normal is coming out of this, and companies that will suffer. The companies that will suffer could be in the real estate sector, on the retail side or commercial side. Getting back into office towers is going to be very difficult until we completely resolve the coronavirus. Getting back into malls, I think, is going to be a little bit more difficult. Foot traffic is going to be slower. Restaurants are not going to be able to operate at full capacity, or if they do, people might still be hesitant to get out there. So there will be a difference in performance in a recovery in terms of what areas recover faster than others. The areas that will recover faster, I would say, would be those home builders, so some of the consumer discretionary stocks. Would be technology, where we are more reliant on technology today than we were, say, 3 or 6 months ago. Just a quick example on that will be, think about how you shop now, right? Obviously, Amazon is a great beneficiary of this, but in addition to Amazon is Visa, where I don't remember the last time that I actually paid cash for something as a result of the lockdowns. Every place is credit or debit. And so, these are going to be the winners and the beneficiaries versus those that were part of the old economy are likely to fall by the wayside.
Thanks, Philip. A question from Victor here. I think it's ultimately a valuation question, but there were some in the market that were saying at the start of this year that there was overvaluation and that there was trouble in the market, obviously before the pandemic, and then we had this unprecedented demand shock. Where do you put valuations now, maybe globally from an asset allocation perspective, and can that help investors and advisors with their asset allocations going forward?
Yes, I do believe it can. Valuation right now is at the upper end of fair value or fully valued. Like, we think the U.S. market is borderline overvalued. Just stretching that line between, or right on that line between fully and over. When we look internationally, we see the same thing, and this is on a trailing basis or forward basis or even 2021 basis. Like, on a forward basis, we have the S&P 500 trading at almost 26 times earnings, but that disregards the earnings for 2021. Again, everyone knows it's going to be awful, so we're looking at 2021. Well, 2021 looks rather full as well. Now, valuation, we've done a lot of work on this, and valuation is a poor predictor of short-term performance, but it's a good predictor of longer-term performance. So it doesn't tell you anything about what the market is going to do over the next year. It tells you what the market is likely to do over the next 5 to 10 years, which is valuation normalizes. I was just looking at one of our studies earlier today, and over the last 50 years, valuation, a change in PE has only contributed 7% of the total return on the S&P 500, where 93% is earnings growth and your dividend. So to us, what we try to do is trying to gauge where the market's going over the next year is a little bit more challenging. But we try and rationalize that with where do we think earnings growth is going to be. And so that's where we see earnings growth being, for 2021, being very strong over 2020, but then you have to attach a reasonable multiple to that, and that's where we get to our upper single-digit returns, which is kind of like, we think we're going to see an average return over the course of the next 18 months. Now, in theory, it could have been above average, but we've gotten those gains already in the last couple months. So when we do look at valuation, we look at it not only on the S&P 500 to its own history, to inflation and rates, and the relationship between where does Europe normally trade to the U.S. And Europe normally trades cheaper than the U.S. and right now it's even a little bit cheaper than normal. Canada normally trades a little bit cheaper to the U.S., but Canada faces some headwinds. So from an asset allocation perspective, we are underweight Canada, we're overweight the U.S. and international. And I do see a question there in terms of the view on the U.S. dollar and hedging U.S. equities. Yes, we do think hedging U.S. equities at this point is a prudent move, given the view that we can see the Canadian dollar strengthen relative to the U.S., even though U.S. equities we think will outperform Canada.
Thanks, Philip. Question from Claire here on emerging markets. Emerging markets have become more of an engine for global GDP, and is that going to continue? And are you favorable on the emerging market space?
Yes, so we are favorable emerging markets. And when you look at the emerging markets, you can lump them in one basket, but we like to carve them out in two. 70% of the emerging market index is Asia related. And so if you look at how Asia has managed the coronavirus, it's done so very, very well in China, South Korea, Taiwan, Hong Kong, and they're almost fully operational again, almost back to normal, not necessarily in terms of out, but business-wise. And so we like that aspect. And Asia is cheaper than what we see in Europe and North America. Then the other 30% of the emerging markets would be more commodity related. This would be your Brazil, your South Africa, Latin America, and so on. And here the prospect for commodities in a recovery actually is quite positive. We could see higher prices for copper, higher prices for oil, higher prices for gold, which would relate to the money supply and weaker US dollar. And so the emerging market basket as a whole, we actually do think is quite attractive over the course of the next, here we do like to take a longer term view. So I would say over the course of the next 1 to 3 years, we think the emerging markets can deliver an above average return relative to the US. But at the same time, that does come with above average risk, and we need to be aware of that. So it is an asset class that we do like right now. In proportion to the US international, it's much smaller of a weight, but we think it's a very worthwhile place to be.
Great, thank you. And Philip, question on market capitalizations. Obviously, there has been large cap outperformance. Wondering what your view is as you think across small cap, mid cap, large cap in the U.S. And just if you see any of those categories outperforming, and for what reason?
Certainly. Well, we've seen large caps perform very, very well. Now, typically coming out of a recession, small caps tend to perform well, and mid caps. So these are more cyclically sensitive. In this instance, while mid caps actually performed well, small caps really lagged up until just recently. And so small caps lagged large caps. And that could be because of the nature of this recession, the nature of the economic lockdown. But as the U.S. opens up, small caps we think can do better. They've started to catch up to large now. Normally, small caps outperform in a recovery, and I wouldn't see why that wouldn't be the case in this instance. And so over the course of, say, the next, again, 18 months, our outlook for small and mid would be better than what we could see out of large. And so this is almost like a standard playbook, if you will. Coming out of recessions, we saw the same thing in 2009 and 10, saw the same thing in 2004 and 5, where small and mid caps tend to outperform large. My expectation is that this would be the same.
Thanks, Phil. And a lot of great information today in the charts. I know that there's a lot that your team works on, and I know that the stuff that you typically share is the stuff that is confirmed, and you guys confirmed is true. Wondering if there are things that you're keeping your eye on right now. So things that are in the pipeline. You're not entirely sure what to make of it, but there are different economic indicators that you're monitoring more closely.
Certainly. Well, we highlighted a few of them. We follow the PMI very, very closely, and we're looking for, in this case, it's the components of the PMI. Inventories are going to be something that we're going to want to pay attention to in terms of, we saw an inventory buildup leading into the coronavirus, as actually it was a result of the trade wars that companies were building up their inventories to manage through it. Now, it looks like we might have excess inventory. Certainly as a percentage of sales, inventories are far higher than what we've seen over the last number of years. And so we got to work down those inventories to get the economy back to normal. We're going to pay attention to the speed in which the labor market recovers. And then we're looking at some market signals too. So for example, we're going to want to see, I'd love to see the VIX normalize, right? The VIX come back sub 20. It's been above 20 for an extended period of time. So it just keeps me a little bit nervous that we could see some more downside or a second leg there. So the VIX would be, I'd be more comfortable if the VIX was sub 20. Copper prices, we've seen copper prices start to move up. Copper is a good leading indicator to the global economy as it's a key input into so many different things. And so we've started to see that recover. Want to get it back to, I'd love to get it back to 270, 275 a pound. That would be very good confirmation that we're solidly in a recovery at this point. As oil demand starts to pick up, that's a positive sign as well. So we have a number of different indicators that we look at that are both economically focused as well as market focused, that will give us confidence that the recovery is solidly in place. Now that doesn't necessarily mean short-term performance will be a lot stronger, but if we start to, instead of thinking over the next year to 18 months, start thinking over the next 3 years, then the return profile can start to look a lot better.
Great, thanks, Phil. And I know your team. Just one more question for you here. I know your team does a lot of work with advisors, and a lot of great work with advisors. And under normal circumstances, obviously, when we're all able to be out on on stage or in offices, you're literally seeing hundreds of advisors, a year. I know that you're still getting questions from advisors, and just wondering if maybe you could share what the most common question you're getting is. Is it related to COVID? Is it related to valuations? What do you think advisors are most concerned with right now?
Well, this is a great question, and you're right. We are on conference calls every day with advisors, with clients, doing events like this. I would say the number one question that comes in is, what do I do with new money or a new account? Because we've seen a significant run up in the market. Do I put it in? My client's been sitting on cash. They've missed the rally. What do we do? There's a lot of that I hear. Now, keep in mind that this rally has not been driven by professional investors or the institutional managers, pension plans, and so on. It's really been driven by retail investors. That there's a number of articles highlighting the fact that sports bettors that can't bet on any sporting activities have turned to platforms like Robinhood, Schwab, and they're using the stock market as their gambling venue. That's not what we want to do. That's not what we want to advocate. So our advice to advisors is rebalance portfolios at the market lows and the market highs. Always rebalance, right? And look at the swing that we've seen in equities. We had a 35% drop and then a 40% gain in equities. That really moves your asset allocation around. If you were able to rebalance in April to your targeted asset allocation, you put yourself in a much better position in the rally, and pretty much have recovered. So rebalancing is absolutely key, and then dollar cost averaging we think is very important. While I said earlier, a lot of the uncertainty in terms of how bad the environment is going to get has been removed, we know markets are volatile. We get a correction on average once every other year, so that's a drop in the market of greater than 10%. In this case, this market has shot up like a rocket. That, yes, I can explain some of it, but does that mean we should be here? No. So new money coming in, I think dollar cost averaging is a very appropriate way to get invested today. Don't fear missing out, right? Because there will be opportunities to buy at lower levels, but trying to time that is very, very difficult. A colleague pointed out that March 23rd, the market was down 11%. Great buying opportunity. March 24th, the market was up 10. Right? So that's how quickly these markets move. So trying to say, what is the perfect time to do this? The perfect time is you stage in over time. That's what our data would show. It's the better approach. Now, asset allocation decisions should be shifted around. So our model portfolio is 55% equity, 45% fixed income. It is a little bit underweight equity relative to a 60-40 benchmark. We make up for that by being in high yield. We do like equities. Asset allocation, thankfully, isn't a binary decision. It's not you're either all in the equity market or you're all out. There are nuances to it. Right now, we think being neutral, being much more neutral, is a better approach. And those would be some of the things that I get questioned about, and we cover off in our conversations.
That's great, Philip. And on behalf of Inside ETFs Canada and obviously ourselves and everyone on the line, really appreciate you taking the time. Thank you for joining us. Where can advisors get a hold of you and your team? I know you produce a lot of stuff. Where can they find you?
We're in a lot of different places, and thank you for asking. We put out a podcast on a bi-weekly basis called Investments Unplugged. You can find that on iTunes, Google Play, or wherever you access your podcasts. You can find all of our research and notes on the Manulife Mutual Funds website, manulifemutualfunds.com. It's there. We work with advisors across the country, so reach out to your Manulife representative, and we can open up a dialogue there. We try and communicate to advisors in the way that they want to be communicated to. So if it's that email, we have a monthly email. If it's podcasts, we do a podcast. If it's videos, we post those to our website as well. So many different ways to access our information, and a lot of it is shareable with clients at the same time.
Thanks, Philip. We really appreciate you taking the time. Thanks again to everyone who joined us. Slides and a replay should be available within 24 hours of today's webinar. You can access the replay using the same link that you used to log in today. Thanks again to Philip and all the advisors that submitted questions. You can find more commentary and insights from Philip, his team, as well as education on ETF content and information about Manulife's ETF lineup on manulifeim.ca. We look forward to seeing all of you when we're back to normal. And if you have any questions, please reach out to your local Manulife ETF specialist. From east to west, Robert Warnick in Quebec, Jordan Blaine in Ontario, and Jonathan Deverne in the west. Thank you and have a great day.